Hey everybody, happy Wednesday, July 29th. Thank you, God, for waking us up this morning. Thank you, God, that we have breath in our lungs today and that we can see, hear, taste, touch, and smell. We don't take this blessing for granted. Let us rejoice. Let us be happy. Let us praise God. Let us love our brothers with brotherly affection. Let us be righteous, kind, gentle, good to everybody we meet, and be lights in this world. Amen. All right, guys, let's get into the lesson today. I'm a little bit sleepy. I'm gonna try to bring the energy for this one. Do my best. So every day, my goal is to release a video like this on a specific chapter of a book that I am reading. Um, 1 second, guys, and we're back. Um, Today's lesson will be on chapters 3 and chapter 4 of How to Make Money with Breakout Trading by Indrazath Shantaraj. I love this book. It was one of the first books that I read when I started learning breakout trading. And to give you context, the reason breakout trading is important is because it's a prime factor in our trading as momentum scalpers. We're in and out within just a few minutes. And well, actually, even seconds. And the setups and strategy that we trade rely on breakouts. Breakout is a term to describe when price is moving through an area very rapidly and it's breaking out per se because of just how fast and how much it's moving through a specific area. So the question you would then ask is, okay, how do we know when it's happening before it happens and where will it happen? Because if you know where it's going to happen and when it's going to happen and how long it's going to happen for, then you can make money consistently. So these are the questions we're trying to decipher with breakout trading. Chapter 3 and chapter 4 is going to break down some of these concepts better. So what makes a breakout real? I move my face. A breakout, not every breakout is successful. There are breakouts, the majority of them don't work. According to Michael Norman in his last book, the majority of breakouts are unsuccessful. So the traditional method was enter long when price breaks resistance, ideally with volume. Okay? This is traditional. You see price breaking a resistance level and it has volume, ideally. The problem is this alone is unreliable. Many breakouts are actually fake. They're unsuccessful. AKA, you get in, you'll probably not make money or you'll lose a little bit of money. So we want to figure out which breakouts will be successful. The fix here is a clear rules-based system. It removes emotion and lets us trade like smart money. So the fix here is a rules-based system, which we is about to explain. That removes emotion and it follows smart money. Smart money is the people who are moving the market and they're deciding the movements. We follow. 4 signs of a genuine breakout. This is very important. This is the fundamental of identifying a good breakout, in his opinion. Of course, there's other books who have different methods. I agree with everything that he says. One, and it's not going to be verbatim or exact, but one, we have a big breakout candle. Secondly, it happens in quick time. Third, there's an absence of selling or selling wick. And lastly, there's notable volume. Let's start with the first one, a big breakout candle. A legitimate breakout happens on a big candle. Smart money's pushing near resistance always produces a big move if the breakout is real. So here in this picture, we see a resistance level, and then the breakout happens with a huge candle that overtakes that resistance level. Let's describe this? So he says, number one, the first important key, the first thing needed is a big breakout candle. A big breakout candle. What does he mean? How do we identify this? So we have our chart, right? And I'm gonna, oh man. 1 second, guys. All right, we're back. So first things first is a big breakout candle. Let's say we have our chart, okay? And so let's say we're right here, right? How do we identify resistance? This right here is resistance. Why? Because we had two levels. Oh, Shift X. So we had two levels right here where price went up to and it got rejected. That, my friends, is resistance. At least, Shift X. At least, what is resistance? 2+ points on the graph where we got rejection. Okay? Price couldn't go up here either time. It couldn't pass this line. It got pushed down. Resistance. Okay? So now that we know our resistance level, we want to predict when it's going to break out of this. Okay? We want to get in on a successful break of this line, because when that happens, it's usually followed by a large movement in that direction. And if there's a large movement, that means we can get involved and get money and capture a percentage. Okay. So I want to break this down as logically as possible, right? So you have your resistance, right? And then when it gets broken, which leads to a big move, which leads to us being able to make money, because you just can't make money if there's not a move. So his first rule in predicting a successful breakout or getting involved in one is that when this resistance does get broken, there is a big candle. Actually, hold up. That there's a big candle overhead. Okay? Big one. That you can see that there is space in between the resistance and the top of the candle, clearly above that level. Okay? That is his first note to look for. That's rule number one. Great, let's get back to the PowerPoint. Rule number two is that there's quick follow through. Price should keep moving in the 1 to 2 candles right after breakout. So we get the breakout. We want to see price follow through 1 to 2 candles pushing through with that level. Those candles should stay big. Small candles or dojis are a warning sign that sellers are there, and this may be an unsuccessful breakout. I think this is pretty explanatory. Um, that was cool. I draw it out. So we have a resistance. We have I touched it twice. Okay, when it does break, right? This is the breakout candle. We want to see more, uh, more big ones like this. Okay, we want to see more big ones forming. Sorry, that did not do it. There you go. We want to see more green big ones. Okay, what you don't want to see. This is good. What we don't want to see, on the contrary, is one big green candle. Okay, let's say this big green candle was fine, dandy, but then right after we see this. Oh, I'm gonna have to draw this by hand. Right after we see this, or we see this, or we see this. Okay, these are warning signs that maybe this breakout wasn't as successful as we thought it was, and so we would respond to that. And he gets into that later. Third, there's an absence of selling. Sellers should be quiet, or smart money is absorbing them. We see this absence of selling by an absence or no selling wick on the breakout candle. The selling, that means selling has been absorbed. That's just, absorption is a fancy way of saying that all the sellers got eaten up by the buyers, because there's so many buyers. Everybody who sold, it's like it didn't even happen because there's so many buyers, aka smart money. So the way you would note this is, we get the breakout, right? We get the breakout. Beautiful. Okay. What we want to see is this candle closing at its high, or a little wick like that. Okay. What we don't want to see is this huge wick. Okay. Let me. You don't want to see a huge wick there, guys. What that means, essentially, what this means, guys, is that there are a lot of sellers. Okay. That means they're sellers. And if they're sellers, they're pushing this thing down. They don't want this to break out. They're going to push it all the way down to here, to here, to here, and we're going to lose money. So we need to avoid them. And how do you avoid it? You spot, you spot, guys, when this is happening. We see it. Okay? We spot it, we see it. We may not get involved because we realize that there's a lot of sellers. That is not the type of breakout we want. We want with a small wick. Next, we have good volume, guys. Good volume means smart money is involved in the move. And I'm gonna break this down in Anna Colling's volume price analysis, but volume is so key to my strategy, and it's a key to a lot of people's strategies. Every day I'm looking at volume, and every move I'm looking at volume. The best setup, show consolidation before the breakout. We learned that from Michael Norman, because there's a squeeze, but good volume means smart money is involved in the move. So let me just draw this one out. Rough. So what we want to see is this breakout candle, and you're gonna see throughout this process, you're gonna see. Oh, yeah. say volume, right? This is volume. You're gonna have your volume indicator up, and it's gonna show you. You're gonna see these lines right underneath. What this is telling you is the amount of transactions that occurred at that price point. When there's more transactions that occur, that signals that there's more emotion. Okay, there's more energy. There's more people at that price point who want to get involved. It's also a sign that there's a lot of money involved. When there's a lot of money, when we smell money, we think smart money, the people who are controlling the movements of the market. So what we want to see is this: a huge volume green candle that aligns with that move. That tells us that there's serious emotion and serious energy behind that move. And that may mean a big institution is behind it, which means we want in. Okay? So when you see big volume, we think smart money. And when we think smart money, we think let's get in. Okay? So he breaks that down. Good volume. That's chapter 3. So those are the 4. Small wick. It happens fast. 2 3 candles are following through. Big volume and a decent size above the resistance. So chapter 4, he's talking about more just systematically how to be a successful trader. Have a trade plan. A trade plan means knowing every rule before you trade. Trading is a game, and the only way you win the game is by knowing the rules. You need to have your rules set up before. And his rules are every plan needs an entry point, a stop loss, where you're going to get in, where you're going to get out, where do you plan on taking your profits if it's successful, how much are you willing to put in this trade, and how much are you willing to put in this trade compared to your entire portfolio. Only take trades with at least 2-to-1 risk-reward ratio. He explains here, if you're making new highs off of this resistance level, you target a 2-to-1 risk-reward ratio or the width of that initial range. How to set targets. On a sideways trend, you can use the width of the range as your target. Or if we're breaking out to new highs and there's no fixed target, aim for 2-to-1 risk reward, trail the stop, or both. Trailing your stop loss. So if we're unsure that the target will be hit because we're seeing resistance from the sellers and there's weak follow through, you want to trail the stop loss. And let me break down what that means. So in trading, you're gonna have trading is on a big chart. Okay, x-axis is time. Okay, maybe using a 1 second, 5 minutes, 10 second, 5 minute, 15 minute, whatever. And then here we have price. Okay, so at the end of the day, the stock market is just a graph with a bunch of lines that's showing us how price is changing over time. Okay, so it's gonna go up, it's gonna go down, it's gonna go up, and then we're looking for a breakout. Resistance identified. We are seeing for this move. We want that breakout. We also want, remember guys, high volume. Bro. You also want big volume with it, okay? Big volume. Instead of before, you see there's probably small volume here and there. Small volume, small volume. We want to see big volume. Okay. In every trade you have, guys, you're doing stop loss, okay? Stop loss is where you get out. So let's say we got in, let's say we got in right here. It broke out. uh, Let's say we got in right here, right at the breakout. Where do you get out? What if this doesn't work? Where do you choose to get out? We need to know this before, okay? So let's say stop loss. So stop loss is just a term to describe where are you going to stop trading? Where are you going to get out? Okay, bro. Sorry. Where are you going to get out? So you may want to get out at the low of the candle. We'll go into further depth about how to build a stop loss out, but you're going to try to figure out where you want to get out. Well, you need to know that before you even enter the trade. Okay. So we know where we want to get out. And that's usually a fixed point. Okay. Usually a fixed point that's set. Okay. That when it hits that point, it is going to trigger you to exit that sale, that trade. Okay. Trailing stop loss is when you can actually move this point. Okay. So instead of just being fixed down here, you can actually grab that and move it up. Okay. You can grab it and move it up. You can grab it and move it up. You can grab it and move it up. So that means you're moving up the spot that you want to exit. And why would you do that? You don't want to risk as much. Or there's two scenarios you would do that. And one of them here is when we see that there is a doji forming or there's some type of rejection forming from here. So let's say they broke out, then we got this candle, okay? Now, it may not make sense to keep your stop loss down here because you already see, guys, that this is going the opposite direction. Why are you going to wait for it to go all the way back here? You're going to wait for it to come all the way down? No, like you already seen this, and this is giving you information, right? Information, okay? Okay, you use that and you respond by moving this up. This tells me that, hey, this breakout has sellers. This may not work out. Why would you put your risk all the way down here? Don't you want to risk less? Save money? So maybe you move it up knowing this information. Or maybe, just maybe, it's a follow through. Okay? Maybe sheesh. This is working. We just got 3 candles broken out. Your original stop loss was down here, right? Well, now trade's going so good, you can even move it up over here. Okay? And now you're still in the trade. You're still in the trade, but your stop loss has moved up. You're already guaranteed money at that point, okay? Because you're getting out right here after you already made money. Look, like if you got in here, oh, let's say you got in here to here where your stop loss is, where you would exit, and the position is right here. Well, this is your profit already, okay? That's yours to keep. Whenever you exit, you still make this. So when things are going well, move the stop loss up, trail it, okay? So when to do a trail stop loss? Either things are going good, and you take profit, risk free, or things are going bad and you want to get out fast. Okay? Get out faster, less risk, whatever. That's what he's saying here. Leveling up your exit. So, as a beginner, you want your exit 100% at the target. Before you get in, you set your target, you know where you're going to get out, you take 100% a day, 100% at that target, and you do 3 setups a day. Enter the breakout, stop at its low, keep a trading journal, then review and improve, repeat. Step 2, once you're consistent, now you only exit 75% of the position at your target point and let the rest run. The reason being, one runner can lead to many, many profits that cover your losses. So I'm going to give you all. So this is resistance, resistance. It doesn't want to get up. And then all of a sudden, we have a break, right? Okay. Let's say your target is, before you got in the trade, you said this is where you're going to take money at, okay? You've decided. I don't know why, but this is your target. This, sorry guys, that's your target, okay? As in, this is where you're going to take off money if it reaches here. That's good. You can, so what he's saying is once it gets up there, take off 100%, okay? So la da da. Our breakout is doing good. We got to the target, okay? Great. We got to the target. So now that we're here, you can do one of two things. You can take off 100%, okay? Or maybe we take off 75%, okay? If you take off 100% and then this happens, if you take off 100% and then this happens, you're good. You already took your money off. If you take off 75%, then you may have just lost money if you didn't have a stop loss. But guys, what happens if it keeps doing this? And it keeps going up. You're watching it go up. If you only took 25% off, you still have 25% in the position making that money. Because what we figured out in the research, not me, but the people, is that breakouts tend to run, as in they run away. You want to be involved in that move. You want to be able to make money because sometimes it goes, man, sometimes it'll go like this, okay? And you started at, today we had a stock that was like $4 and it went to 7, you know? It just took off. You want to, let's say you get out at 75%, but you want to have a little bit here to make money, okay? And that's what he's explaining. But that only comes in like later once you've respected. So a good trading system is only 10% of success. So what he's saying is up to this point, that's about 10% of success. That's technical. The rest is risk management and emotion management, which is true. To make sure you don't blow up your account, risk only 10% of capital per trade. So if you have $100, it's $10, $1,000, $100. So that when you use your stop loss in the trade, you're probably only risking about 2%. Never deploy more than 50% of your capital until you've traded through every market. There's 4 different types of markets. There's uptrend, downtrend, sideways trend, random trend. What type of market are we in right now? It's been slightly bearish and it's coming back to neutral as of this week because there's been a lot of opportunity. So I would say it's probably a bit of a sideways trend, up, down, up, down. I wouldn't say June was a very bullish month. Everybody was winning. It was bearish in early July. Now it's starting to feel a little bit more bullish. So what I mean by that in June is in June we were going up, like there was opportunity. And then July, oh man, like there wasn't that much. Now starting to be like, okay, maybe there's a middle ground where some days the bears win, some days the bull win. just the amount of opportunity we have and follow through. So you won't know if your system is good until, or you have an edge until you've succeeded in two or three of these markets. So you need to be able to make money in the uptrend and the sideways trend. Downwards trend, if you can still make money, then you're a beast, right? Then you really have your emotional management on par because you're not allowing yourself to get taken away by emotions. Um, so when you notice that your edge isn't working anymore, don't go change the system. Change your emotional management because what's most likely happening is you're losing money and your emotions are dictating everything and you're blowing your account. Um, that's it for chapter 3 and 4. Financial advisory here. This presentation reflects personal notes and it's for educational informational purposes and does not constitute financial investment or trading advice. Trading does involve substantial risk or loss and may not be suitable for everybody. Past performance is not indicative of future results. Always do your own research. I am not liable for any actions taken based on this video. But just wanted to summarize with y'all guys. Still learning this thing. Nope, not doing that. Big box. And I'm gonna type in this. So what did we learn? Okay. And make that huge. What did we learn? If you walk away with anything, a successful breakout has 4 things. Big move above resistance, small candle wick, big volume, and follow through. It happens fast. Okay. What else did we learn? His second part. So that was his first chapter. His second chapter came in risk management, emotions management. Um, I feel like I'm forgetting a gap before that part. Having a trade plan. Yes, that is very important. Have a trade plan. You know before you trade where you're gonna get, where you're gonna enter, where you're gonna exit if it doesn't work, where you're gonna exit if it does work, how much money to use, and what percentage of that is a portfolio. Okay. What else? A very important key that he talked about here is runners. Okay. Let 25% in the trade if it's working for exponential gains. And lastly, the market cycles. Okay, there's different market cycles. There's an uptrend, there's a downtrend, there's bearish, and then there's random. It's not going to be like this all the time, but stick to the system in these times. Okay, trading at the end of the day is 90% risk management, 10% technical. Okay, that's what we're on. So that's what we learned. Hope y'all have a blessed one. Enjoy the evening. Love y'all. And we'll be back tomorrow with some more research, more education. Bye.